This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through and have a look at a question. This question, unlike the previous question we did, which actually went through and got us to prepare a group set of financial statements, that was just purely revision to help you understand the principles. Remember, now in strategic business reporting, you're not going to have to prepare a full set of group financial statements. You're going to have to prepare extracts from them. So there'll be some calculations, but there'll also be some discursion element to it as well. Okay, or discursive, I think would be a better way to describe it, wouldn't it? So this question is getting a little bit more towards your exam type question. So what have we got within the example? Well, if we have a look at the requirements, I'm just focusing on the calculations at the moment because I think it's important that you can do the calculations first before you then think about the explanations. I think the more you calculate it, the reason why you're calculating it as such is because you're thinking about the rules. If you're thinking about the rules, you can then put that thought into a discussion element. Okay. So what you've got here, both parts are to go through there and do some form of calculation. Obviously, the real exam will be calculate and explain. But here, part A wants us to work out goodwill. So that's going back to your standard workings that you have for goodwill, looking at the fair value, the consideration, adding on the non-controlling interest, and then deducting the net assets at data disposal. And just note it wants us to work the goodwill based upon, is it your proportionate share method and then the fair value method. Pardon me. So remember, the proportionate share method is also referred to, isn't it, as your partial goodwill, and then the fair value method is referred to as your full goodwill, isn't it? Okay. Hopefully you're familiar with that from the days of F7 or financial reporting, to give its more up-to-date name. And then in part B, it wants you to work out your group retained earnings. So is that your standard working 5? And then is it there your other components of equity, which is what we touched upon, wasn't it, very briefly in the video before. Okay. So that's looking at where we hold, is it our revaluation reserve, which is the one that we tend to see within group accounts, but also share premium, your gains and losses on fair value through other comprehensive income, financial assets. There are other components that go into there, but we'll see those later as you progress through the IFRS. I don't want to touch upon them just yet because it might just get you just a little bit too fearful of what you're going to see. Okay. So part A wants us to calculate the goodwill, the proportionate share of net assets method. So I think what it would be useful to go through and do there is to lay out your pro forma, isn't it? So you've got there, is it your fair value of the consideration? We then add on the non-controlling interest. And then we go through there, don't we? And deduct the net assets at acquisition. Okay. Again, that's for your proportionate share. That's part 1. Part 2, it's exactly the same, isn't it? So we go through there, don't we, with your pro forma. And look at the fair value of the consideration. We add on the non-controlling interest. So again, in this instance now, that's at fair value. And then we deduct the net assets at acquisition. Okay. Everybody happy with that as a standard working? Hope so. Good. Then what you got, part B. So B, you had 2 things to consider, wasn't it? One was the group retained earnings. So remember, that's your standard working 5. So even though we went through and prepared the consolidated accounts in that earlier example to revise everything from F7 and financial reporting, it's useful to see how it pulls into strategic business reporting and preparing those extracts, isn't it? Because in the group retained earnings, you've got 100% of P plus P share of S's post-acquisition. Okay. And then don't forget as well, you've got then your group OCE, other components of equity, which is like a standardized working 6, isn't it? Or just a repeater copy of working number 5. So that's whereby you put in 100% of P, and then you add in P share of S's post-acquisition profits. Careful, not profits here. There will be share post-acquisition other components of equity. Okay, and what you may find it useful to do, I don't know, as the syllabus progresses and we get more past exam papers, we'll see. But I still think it would be useful to use that net assets working, particularly in this instance, because you're looking at several areas of our standardized workings. So S is net assets. You take that at year end, so your reporting date. You take that at the date of acquisition. And then we look at what happens post-acquisition, don't we? Okay. So what have we got? We need to go through there, don't we, and look at the background information. So you've got the requirements there. We know what's happening. If we look at the scenario here, it tells you about Luke operates in the manufacturing sector. You've got your financial statements as follows. You can see there that Luke has an investment of $5.4 million in Han. The likelihood there, I presume, is that Luke is the parent, Han is the subsidiary. You've then got the equity and liabilities at the bottom of the statement of financial position. Again, there's going to be some really useful balances in there, aren't there, in terms of looking at the retained earnings of the parent, because does that normally feed into working 5? The 100% of the other components of equity will go into working 6. If you're looking at the net assets, well, you've got them there, haven't we? The net assets of the subsidiary at the reporting date, haven't we? Okay. Assuming that Luke is the parent and Han is the subsidiary. Okay. Let's just double check. Is that the case? It is. So it says there on the 1st of January 2015, Luke acquired 80% of the equity interest of Han. So therefore, we own 80%. We have control. The non-controlling interest own 20%, don't they? Okay. We're told there's a cash consideration is at 5.4 million. The net assets had a fair value of 3,400, and the retained earnings were 600, and other components of equity were 400. And then we're told that there's a fair value adjustment which is due to land. Okay. And then in the second point, the fair value of the NCI. So that's going to be useful, isn't it, for A, part 2. Okay. There we go. I think it's really useful to lay out the pro formas, because once you've got the pro formas, what we can go through and do there is we can put the numbers in as we see fit. Okay, so you've got 5,400 in terms of the fair value consideration in A part 1 for the goodwill, and then in A part 2 you've also got the 5,400. Okay. The non-controlling interest at fair value, we're told there was 700. So the non-controlling interest at fair value, so note that's in part 2, is there at 700. So 5,400 plus 700 gives me there, is it 6,100. So that's the total worth of that subsidiary. Okay. When we're coming to, is it A part 2, the NCI is going to be 20% of S's net assets at the date of acquisition, isn't it? If I'm filling in the blanks, again, we own 80%. So P shares 80% of S's post-acquisition movement in retained earnings. 100% of P. 100% of P's retained earnings are there at 3,200. So we can put that figure in there, 3,200. And then is it there for the group or the component of equity? 100% of the parent there is the 1,000. So, oh, careful, step too far. And again, we're just going to work in round thousand because that's what the figures are quoted at within the question. My net assets of the subsidiary. So what we've got here is there is some share capital, so equity share capital. There's some retained earnings, and there's some other components of equity as well, isn't there? And what we can do is we can copy those down, can't we, from S's statement of financial position at the reporting date. So 2,000, 1,000, and 625. 2,000, 1,000, 625. The date of acquisition, which I think was the 1st of Jan 2015, so it's at the start of this year. The share capital will never have changed. Okay, so that will be the 2,000 as well. The retained earnings, the other component of equity, what have we got there? Well, we're told there that they are 600 million, and is it 400 million? Did I say we're working in thousands? We're actually working in millions, careful. Okay, there we go. You may have spotted that as I was saying the word thousands. We're working in millions. So is it there? 600 million, 400 million. So I can put in there, is it 600? Is it 400? And then this is the crux. Because what you've got there is it says the net assets of Han. We recognise those net assets on consolidation at fair value to reflect their worth on acquisition, and that's 3,400 million. So these net assets need to total 3,400 million, but they don't. Okay, if you total them up based upon book value, the 2,000, the 600, and the 400, that gives you, is it 3,000? We need to put in a balancing figure, and that balancing figure is 400. Okay, that balancing figure relates to land because it goes through and says there the excess in fair value is due to an item of non-depreciable land. So there, that land was 400 at the date of acquisition. We're not told about it changing in any capacity. So we will assume there that that is then the same. If it was depreciated, so it was another item of property, plant and equipment as opposed to land, that would be depreciated for the year, okay, based upon its remaining useful life. So if you're interested, the net assets at year end are 4,025. Okay. Post acquisition movement on retained earnings is 400. Post acquisition movement on other components of equity is 225, isn't it? Okay, there we go. Again, if there's any mistakes, point them out, let me know. I'm only human. Okay. There we go. So net assets at acquisition 3,400. Where's that useful? Well, it's going to be useful in my goodwill working. So the net assets at acquisition at 3,400. 20% of 3,400 gives me 680. So does that give me 6080? So does that give me in total 2680 for my goodwill under the proportionate share? So that there is my partial goodwill. Partial goodwill meaning that that is the parents only. Okay. Here you've got 400 as the net assets. Does that give me 2,700? So a slight increase compared to part 1. And that's the full goodwill, because that is made up of the parents and the non-controlling interest share. There we go. Okay, so we have, is it an extra, only 20 million, which is the NCIs. Okay. Then we need to go through and finish things off in terms of the group retained earnings. The post-acquisition profits that you've got there are the 400. So 400, 80% of 400 is that 320. I'll do it on my calculator just to make sure there's no mistakes. Does that give me 3520? And then is it there for the other component of equity? It's the 80% of, is it 225? So 80% of 225. Does that give me 180? Okay. Add that together gives me 1,180. Okay. So effectively what you've got there, remember you group other components of equity, your group retained earnings, they are reflecting ownership, aren't they? Okay, the group retained earnings is reflecting ownership in terms of what the parent owns. So it owns its own retained earnings and then its share of S's post-acquisition. And similarly as well, the other component of equity is reflecting the ownership, again, of the parent within the group, isn't it? It owns its other component of equity and its share of the post-acquisition other components of equity. I keep saying profits, but other components of equity movement. Okay. There you go. And I think it's really useful to have that working. I know we don't use all of it. Again, just remember this figure here, this 400, that's a fair value adjustment. So that should form part of PPE on the group statement of financial position. So 100% of P, 100% of S plus that fair value adjustment, because S will not have adjusted for that within its individual accounts. That fair value adjustment to land is only within the group accounts because the subsidiary must not have adopted the revaluation model for its property, plant and equipment, and specifically land. Okay. One tiny little bit that I'll just go through and put in just to give you a better understanding. Here, the full goodwill. We've said the full goodwill is all about the parent share and the NCI share. So what have we got? What is the parent share? What's the NCI share? We could work it out by comparing it to A part 1. But effectively what you've got is the way in which we calculate goodwill is we look at what we've paid compared to what we've got, don't we? Okay. And what you get is your share of the net assets. So in terms of P, in terms of the non-controlling interest, well, the parent paid, was it 5,400, and the NCI paid, was it, let's just double check, I think it was 700. Yeah, it was. They haven't officially paid 700, have they? But that's what their 20% investment was worth, wasn't it? 700. What have they got? Well, P's is 80%, isn't it? The NCI's is 20%. So here, P got 80% of the 3,400. Does that give me, is it 2,720? And the non-controlling interest got 20% of the 3,400. So that goes through there and gives me the 680. Okay. So if we look at that now, P's goodwill, 5,400 less the 2,720 gives me the 2,680. And then the non-controlling interest is there as 20. Okay. And if you add them together, it's magic, isn't it? Because if you take 2,680 and 20, you get 2,700. Bear in mind, I'm not answering the question. This is just demonstration. We've already answered the question and finished that before. This is just to show you that full goodwill is made up of the parent share of the goodwill and the non-controlling interest share of the goodwill. And that is therefore that when we then get any impairment in goodwill, and that impairment of the goodwill is an impairment of the full goodwill, is then the reason why when we allocate that impairment, we reduce the goodwill, but then we take the other side of the entry to the group retained earnings and give the parent their share. So the parent share of any impairment would be 80% within the group retained earnings, and then any of the non-controlling interest share, so 20%, will go to the non-controlling interest working, which would be their working for. Okay, so I think that's just a useful bit of extra information that we can use that example for to help us in case there are any impairments that arise within any future questions that we may cover, or if anything that then comes up within the exam.